Without further ado, I will hand you over to Hannah Peterson-Smith from Linklaters.
Thank you. Thank you, everyone, and welcome to our webinar on initial margin. I'm joined by Jakir, Emma from HSBC, Chetan from Margin Reform, and Deepak and Will Liu and Donahue from Linklaters. So Will and Doug are joining us remotely from New York, and we're in London. So we've been on this journey for quite a few years now, and so it's a very collaborative area, and so we wanted to come together and share some of the lessons we've learned from phases 1 to 5. So we've got lots to talk about, so I won't talk anymore. I will instead go over to Will to ask. So one of the things that makes IM quite different to PM is that not all institutions will be caught. There's a concept of AANA. So Will, do you think you could give us a bit of an overview of how you calculate your AANA and what it means?
Yeah, sure. So the first thing you need to do, can you guys hear me? Just want to check.
Yeah.
Okay. So the first thing you want to do is see if you're actually in scope for phase 6. So you had to figure out what your AANA number is. Unfortunately, depending on who you actually trade with, you might need to calculate more than one AANA. And so sort of adding to the complication, the AANA calculations are slightly different across various jurisdictions. So generally speaking, the AANA is calculated on a margin group basis, but how that's determined, there's spaces between the jurisdictions. For example, in the US, it's more straightforward. You look at the accounting standard to see if you're part of the same consolidated group for accounting purposes. I think EMEA is a bit different, which Dee will speak on that a little bit later. And then you look at the measuring periods for the AANA calculation under various jurisdictions. So in the US, I guess there's sort of a good news in the the past couple of years is that CFTC AANA number is in line with the EMEA and UK EMEA calculation. So for the phase 6 compliance that you look at the March, April, May period of 2022, and then you look at your average of the month end AANA number. But the complication in the US is if you're trading with a dealer who's subject to the potential regulators margin rules, the AANA calculation period for phase 6 is actually June and July and August of 2021. So you would be able to see if you're in scope or not right now. And the calculation is also slightly different. You look at the daily average aggregate notional amount over that 3 months period, rather than looking at the month-end number for each month. And if you're trading with a US dealer that's subject to this SEC margin rules, there's actually no AANA concept on the SEC. So whether you're in scope or not, or based on your entity status, your dealer counterparty's entity status, and also you're really looking at whether you're going to be above the 50 million threshold. Sorry, go ahead, Hannah.
Sorry.
Yeah, I'm just going to move on to this. So the trade population is slightly, the in-scope product are obviously slightly different across the various jurisdictions. Just on the US side, so all the in-scope products under the US margin rules are in scope, but you also have to include deliverable FX swaps and forwards, who are actually not in scope of the margin requirements, but you do have to count that in your AANA number.
Great. So I guess Deepak, from the UK and EU perspective, is there any differences we should be aware of?
So a couple of things just to add. So firstly, the fact that you're talking about UK and EU, so that's a newish development, because when uncleared margin first started, we were just talking about EMEA, but obviously we need to talk about UK EMEA as well as EMEA. In terms of the months, we're looking at the same months. We're looking at the month-end averages. Please don't wait until the end of May before you figure out whether or not you're going to do anything about phase 6. So there's a lot of work to be done in advance. We get a lot of questions about group, as Will was alluding to, because you are measuring the AANA across all entities in your group, and that's particularly challenging for those entities who aren't actually subject to EMEA or UK EMEA, because they then have to kind of ask themselves the hypothetical question, what would my AANA be, were I an EU or a UK established entity. But no, otherwise it's similar. You're looking at all of your uncleared trades, whether or not those trades are actually in scope for posting IM.
Thank you. And then actually, before we just move on to HSBC and margin reform, one quick question. So once you're in scope, if you're in phase 6 or even if you're in phase 5, is that it? Or what happens? Can you be de-scoped, I guess? Will, do you want to take that?
Yeah, so on the US side, so once you start calculating number, you almost have an obligation to do that every year. The reason being is that you could actually fall out of scope even after once you become in scope. So for example, you could be in scope for phase 6, but the year after that in 2023, you could actually also fall out of scope. And under the US margin rules, if that were to happen, you basically can cease posting initial margin for all of your new trades and your existing trades too. So you sort of get like a rebate for all of the IM you've been posted back. And that determination for CFTC is going to be sort of on the September 1st of each year. Looking back at your March, April, May number. And then for the US Prudential Regulators AANA determination, you look at the 3-month period, July, August, summer from the previous year, and the change of status will occur on the January 1st of each year.
Great, thank you. And Deepak, is there any differences in?
So the thing I would say is actually most people are trying hard just not to be in scope in the first place, actually. So, thinking about compression and clearing and things like that. But to the extent they are in scope, then yes, it's an annual test. And if they are fortunate enough to then fall out of scope, actually the rules aren't crystal clear as to what happens for the trades that were entered into for the period of time during which the rules were applicable. We take the view that actually you probably still have to continue posting, but as I say, the rules aren't clear on that.
I was just going to say, just one thing I think is quite sort of interesting to know is obviously you're doing your AANA calculation to determine whether you're in scope, but then there's this big sort of thing saying, but are the products I'm trading actually in scope for initial margin? And that's always been kind of a quite interesting one, because you may actually not end up really having to post margin. And I think you're going to go on and probably talk about monitoring in a little while, and that's where that can kind of come in. But it is quite a big discrepancy that people can be brought into scope, but yet maybe a majority of the trades that they're actually putting in place are not IM covered transactions.
Yeah, no, that's true. And then Jakir, do you want to talk a bit about, I guess, how you're gathering that information and then some of the conversations you're having when you receive that?
Yeah, sure. So we spoke a bit about knowing the US AANA period has already happened for phase 6. So under those rules, surely have that information to do that calculation. But for the UK and EU, obviously they are next year in that 3-month period. If you ask any dealer who has taken on UMR as a project and as a guise, it can take months, if not longer, to actually put into place IM documentation. And that doesn't even take into account the decisions that need to be made from a custodial aspect or an infrastructure perspective to be able to start those conversations. So what HSBC has done alongside Linklaters, alongside ISDA, there's a number of ways to disclose your AANA. And what we have done this year and in previous years is look to ask counterparties speculatively, if you believe that you might be in scope, if you might have over 8 billion in derivatives in that period, raise your hands and start having a conversation with your dealer community. Before you even have any of those infrastructure type questions, there's a lot of information that you could gain from your counterparties that have done this in previous years, or even outreach to Chetan or other consultancies to try gain some information on what would need to happen in that intervening time of today through to March next year. So there is the ISDA roundtable where they have been asking for self-disclosures. We know AcadiaSoft has been trying to do something similar. IHS Market obviously have that self-disclosure. I don't believe there's any one single perfect way of doing it. We've been in previous years very agnostic to how to actually declare. We're happy to take an email, or even would you like to have a conversation with us? So we know between at least our counterparties and across the market, we'll be outreaching and trying to start that conversation. But feel free to kick off a conversation with your dealer community or reach out to ISDA and start those conversations as early as possible.
I was going to say, sorry, just to add one thing on that, and perhaps I'm mentioning it because it's a particular peculiarity to HSBC, but some of your dealers, will be global organisations like we are, and we have a number of hub sites that trade derivatives. So particularly for HSBC, we're in France, New York, London, and Hong Kong. Now, we mentioned UK and EMEA at the beginning. There are different margin regimes for each jurisdiction. And when you're trading with a group like HSBC, you will be facing our entities, but each of our entities are directly subject to these different regimes. And actually, when you look at the AANA calculation, the way it's stipulated, everyone sort of bands about 8 billion, but actually it is in the relevant currency. Well, it's not in Hong Kong dollars, it's not 8 billion in there, but, when we're talking about, US dollars, euro, the 8 billion number. And actually in previous phases, we've had interesting situations, haven't we, Jakir, where we've faced a counterparty who breached the Hong Kong threshold, was it, but didn't breach the US one. So you're kind of documenting with one but not another, because actually, if you're so very close to that 8 billion number, but because of currency fluctuations, you trigger one set of rules, another. And that's just something I think for people to be aware of, because the person you're facing, you may actually need to do that calculation kind of multiple times, looking at different currencies.
And it is complicated because the calculation is different in each jurisdiction. Currencies are different, so you really do need to be.
There's also different products as well, and you guys mentioned a really important point about the regimes, and what the first step is that kind of self-disclosure. And there's a questionnaire, and it's really good the dealers send you these questionnaires, so you can go through each of those questionnaires, fill out what regimes are in play, and also then that allows you to prioritize what relationships you're going to focus on. So that first two steps is really important for everyone to do. Work out your AANA, engage with your counterparties, understand what regimes are in play, and then go into the next step, which is around repaper it.
So the other thing that we're also seeing, I think we will see more of for this phase, is hitherto we've seen mainly principal to principal, right? So, but now we're going to see investment managers slotted in between. So one of the things that they have to do in particular is communicate with each of their clients to say, okay, look, we know we run this bit of your portfolio for you, but actually we need to know holistically, are you going to be in scope under your applicable regime, so that we can make the relevant steps, preparatory steps for you?
Yes, yeah.
So when we're looking at those beneficial owners, we have seen in the past, they do need to reach out to their investment managers, tell them I might be in scope, and we may have multiple touch points across many managers with an underlying beneficial owner. One thing we have seen is beneficial owners notifying certain investment managers, but not others.
Oh, great.
Which is not helpful in the grand scheme of trying to ensure compliance across a market. But it is actually important to at least tell your investment manager or tell the underlying counterparties that you are in scope, even if you don't expect to do any trading going forward, or we're not going to reach the 50 million threshold, which we'll come on to later. But if you don't make that disclosure to your counterparties, then you're not likely to be meeting the other compliance aspects which need to happen, whether it's monitoring, whether it's papering, whether it's at least having an agreement that things are in scope and things are.
Which then brings in another point, right? Which is, it may well be, so if I look at, EMEA or UK EMEA, it might be that you've got an entity that is actually sitting in, I don't know, New Zealand or Australia, where they have nothing to do with EMEA or UK EMEA, but by virtue of the entity with whom they are trading, they need to be able to kind of assess where they are under those rules, as Emma was saying. And actually, so that initial step in terms of getting in touch with your investment manager is not a straightforward step.
Yeah, the whole market needs to be kind of reaching out and educating to make sure everyone has got. I guess we've touched on thresholds, so I don't know, Will, do you want to just give an overview of what the threshold is, and we talk a little bit about threshold monitoring, maybe?
Yeah, so threshold is sort of after you're in scope. I think the next question is whether you're actually going to above the reg IMA threshold under each jurisdiction, which is 50 million in the US. So that's actually an interesting question, right? You could be sort of in scope on phase 6, but you actually have a certain runway before your portfolio reaches the size that's going to go above the 50 million threshold. And that's sort of in a sense sorted out if you have documentation in place, because the IM documents will have the 50 million threshold, and there will be no margin posting obligation if you don't go above the threshold. But even before that, there's a question of whether you actually want to or have to put into the documentation in place. Some under the U.S. side of things, there's relief on regulators to say that you actually don't have to put the documentation in place unless you get close to the threshold. So in that sense, the dealer would sort of engage in threshold monitoring, given that in the U.S. the regulatory compliance obligations on the side of the dealers. But that would put buy-side entity in an interesting situation, because you certainly don't want to sort of go above this threshold and then have to cease trading, and then sort of try to get your documentation in place in the meantime in a rush. It's almost like there's actually a lot of preference from the buy side to sort of put in documentation in place. Not for everyone, but definitely some of the clients that we speak to, because once you have documentation in place, you don't have to sort of worry about the situation where for some reason you put on a big trade, unexpectedly you go very close to the threshold or go above the threshold, but you don't have the docs in place to trade.
Yeah, because it's quite complicated, right? Because when you're putting into place the threshold, it's group to group, so it's not so simple as me and Chetan having a 50 million threshold between us. If Chetan's part of the group with Deepak, then we've got to share that threshold across. And I guess also some of the points we've talked about currency. So Deepak, I don't know whether you want to say the threshold on the UK.
So euro denominated. So you're right. Again, you've got to think about where the currencies are, and then the other thing is just how quickly you're likely to eat up that threshold as well is super important.
Yeah. So you could have a scenario where Deepak's in euro regime, I'm in the US regime. So we both need to make sure we don't breach the $50 million or 50 million euros. And what you find is some of the dealers would have an FX rate, so it would drop it to 30 or 40 million. So you don't have actually 50 million anymore to play around with. So it's important to understand how you're going to balance your thresholds. And then to earlier point that Deepak made, when you have the buy side with multi-managers, how do you split that 50 million across those investment managers? So we've got a phase 6 that has 4 investment managers. And one of the challenge now is working out how they're going to split that 50 million with their investment managers.
And just one other thing, I know we'll come on to documentation a bit later, but actually when you're putting different documents in place, you may actually have different base currencies to the actual regime that applies, right? So you do have to think about what currency in your documentation you're going to be expressing the threshold in, and then obviously if it's split and whatever, so it may be that threshold gets a bit of a haircut along the way, but people need to do the math.
When I think about threshold monitoring across the market, I like to do a visualization exercise of this balance beam. And on one side, you have legal documentation and costs. You have regulatory alignment. You've got custodial and infrastructure and all that future state architecture type things that you would need to do to be able to move IM over and above what you would do for variation margin on a daily basis. On the other side, you have threshold monitoring, which does away with almost everything on this side. You have a calculation obligation, or at least your dealer may have a calculation obligation on a daily basis, which is that threshold monitoring service that we talked about, which can be fairly lightweight. But what you have, what I think we've all just been alluding to, is that theoretical trading cap. Mm-hmm. So we say 50 million, that could be 48 million if you add in Hong Kong dollars, it could be 5 if we talk about euros, and if it's only euros specific. But if we look at investment managers or across multiple groups, we could be splitting that, and then we could be adding in soft limits. So on the right-hand side, when we're talking about threshold monitoring, we're talking with your counterparties about appropriateness. Is it appropriate to use threshold monitoring? Because let's let's assume all my activity is cleared or physically settled, and that's what's really taking me over the threshold. Threshold monitoring is probably the right thing to do. If I am a multi-managed beneficial owner, threshold monitoring starts to become much more complicated because my threshold may be split more entirely by me, depending on how you're documented or how your relationship is split. Maybe your investment manager has agreed to do initial margin for you and will do all the setup. Or maybe I will do that myself and everyone's on a mandate. That conversation is a conversation that needs to happen early.
Yeah.
And with your dealer community, and at least with HSBC, what we've done is over the past few years, we've been running daily sim calculations and grid calculations for every one of our clients. And we've taken a view of whether we think it's appropriate to put in place the documentation because we see the trading is going to go over a certain limit, or strategically, we don't want that theoretical cap of trading when we get there, stop trading. We'd want to carry on whether it's moving margin or not is the right thing to do. So we need to have those conversations across the market, have those conversations internally and with beneficial owners on, are we putting in place with certain counterparties, a certain amount of documents, and we're willing to move margin on certain relationships while giving relief to other relationships within the group and not having to pay for those and using threshold monitoring.
And one other thing, actually, Jakir, I'll add to that, because again, it's probably something that's in our minds, and we've looked at this in probably the last phase, is what probably a lot of people have to think about is, for institutions like HSBC, we're not just kind of papering one or two, or even if we do deem it's appropriate to paper someone, at the end of the day, we are all heading towards, I hate using the term big bang, it's been bandied about too much, but 1st of September, if you are over the 50 million and you're in scope, it needs to be papered, otherwise the consequences are you're stopping trading. And the thing is, there will be a huge amount of counterparties that do actually fall into that bucket. And that has to be the priority, because you don't want to have a situation where, trading is interrupted. And because you've got this big volume and you're all heading towards, can I use the word bottleneck? put them all in there. Yeah. But, the point is, it may be the case that even though the decision is, yes, it's the right thing to put documents in place, you have got a little bit of a buffer so you can go beyond the September, right? And we've sort of looked at that because at the end of the day, and Jakir's our global program manager, so has to make sure everything's done by the right time. But, when you're dealing with a huge volume that you have to get done, there will be some overspill.
Yeah. I think that's spot on. So when we're looking at appropriate threshold monitoring, the steps to take now are get those sim calculations or grid calculations, whatever's appropriate to your portfolios from all your dealers. Agree with them early whether or not threshold monitoring is an appropriate way to do this and keep this relationship going. And if it is, great, there will be certain requirements that you need to put in place, and we can quickly tie this up with a bow fairly quickly. If it's on the other side, and I think for the rest of this conversation, we should probably assume that threshold monitoring isn't appropriate and we need to do documentation, that's what we need to start thinking about now. And whether or not it's September's a hard deadline, because exposures of that IM relatively mean we'd crack that September, that whatever that threshold is, fairly quickly, or whether or not it's a 3-month horizon or a 6-month horizon, prioritizing your work based on when you're actually going to go over that limit is the right thing to do.
So a couple of observations from what you guys were saying, actually. Firstly, you talked about stopping trading when you get to the soft limit or the hard limit. Actually, kind of my take is, in some circumstances, even stopping trading isn't enough, because the market movements on the underlying portfolio could still take your IM number beyond the soft or the hard limit. So that's kind of one thing for people to think about. And then the other thing that we're coming across, particularly as we now enter the later phases, is with the earlier phases, most, I think, certainly the clients that we work with had kind of balanced books. And so you had inherent offsetting within the books to make sure that the IM number was, you could sensibly assess where that IM number would go. But now, as we see kind of more single directional portfolios come into play, then I think what that means is you're you're more likely to see big jumps in the IM number, which are then stresses the threshold monitoring approach.
You're right, because people looking at the numbers don't realise that if you put a large notional trade on, like 500 million, all of a sudden the IM just jumps overnight. So I worry that people are banking on this threshold monitoring to get themselves out of UMR and sweep it under the carpet. But when you look at what happened in phase 5, you know, the 300 so-called phase 5 firms, I think 80% of them use threshold monitoring. So now at some point they're going to breach the threshold and they're going to come in with phase 6. And then to that point, it's going to be a bottleneck for people trying to get over the line. And it's just, you need to understand what the strategy is, and using your, like Jakir said, using your SIM numbers and your grid numbers from your dealers is really important, because it allows you to validate the portfolio, and it allows you to prioritize, here are my priority 1 relationships, and then focus on those ones, get them repapered, get custodian accounts set up. And we had one client that didn't want to go threshold monitoring. They just stopped trading and then they repapered their priority 1s, and that was their strategy. But there's no right or wrong reason. It's a good way to take the pressure out of the project, but not bank on it completely.
It's very individual.
Yeah, definitely. If there are certain trading strategies and certain currencies and products which are very sensitive to the SIM model, that can go from 0 to 40 in a single trade with not a very large notional, but the underlying volatility is there. And those inputs into that SIM calculation, those are the things that you'd want to know from your dealer as soon as possible, whether it's trades that you've already done or you've done in the past so that they're modeled already, or certain types of trades that you think you may want to do, asking how much SIM they would actually produce if you were to do them. That's the type of information which helps you guide you into that appropriateness question, is threshold monitoring. Because we could go from 0 to 50 in a single trade, and the market, as you're saying, it moves behind you.
Yeah.
Volatility increases. You're into levels where you are under regulatory stress.
Well, I think maybe we'll switch gears a little bit. And so the next, like one of the other big.
Hey, Hannah.
Yeah. Hey, Joe.
Would you mind if I just jump in with 2 observations quickly? Okay. The first one, threshold monitoring is obviously complex, and we need to look at it on an individual client basis. But one thing that I've seen developing and that I think is really interesting, and is potentially going to make it even more complex, is that on the multi-manager side, I think managers are starting to figure out, okay, you know, how's threshold monitoring going to work for me? And is someone else going to eat up my threshold? Some other manager going to eat up my threshold? And should I get out in front of that and sort of reserve a piece of that threshold so that I know where I stand and I'm not surprised? So I think we'll see that a lot more in phase 6. And then if I could just go back to the AANA discussion, just a quick practice point for people. So I think, you know, everyone on the panel highlighted the fact that the rules are slightly different across different regimes, and you may have to calculate under multiple regimes. One thing that I would point out for people, or maybe suggest that people take a look at least for a base guide, is ISDA has really good materials on products that are in scope across different jurisdictions, as well as the differences across different AANA calculation periods, and whether or not you average on a month-end basis or a daily basis, and what months are covered. I think it's really important for people to get a good sort of foundation on that. It's very, very complex, the AANA calculations, and in my experience, if you don't have that good foundation to understand what the differences are amongst the regimes, you're never going to get to the right point. So, you know, you can start, maybe it'll make the work a little bit easier for people by starting with some of the resources that ISDA has available on both the product table and the AANA summary.
Yeah, and actually Amy from ISDA did send us the link to send out, so we'll send that out with the materials after, because ISDA has produced a whole host of materials that is available for members, so we definitely will be proud of it. Yeah, so I was going to then move on to talk about custodians. So variation margin custodians aren't relevant, but for initial margin, the collateral has to be segregated. And people have been using custodian. So, Deepak, do you want to talk a little bit about the difference between tri-party and third party and CSDL?
Yeah, so I cut this kind of 2 ways. So in terms of types of custodians, you have the bank custodians, so the Bank of New York, Northern Trust, and so on, and you have the central securities depository, so Euroclear, Clearstream. So those are kind of, you know, the 2 paths that you can go down. And then the other distinction that you have with custodians relates to the level of service that they're offering. So you have the distinction between third party and tri-party. So and really that distinction being, with tri-party, they do more for you, right? So they will check the numbers, choose the collateral, send it over. With third party, you've got to do a bit more of the running and actually give the instructions. And so what we saw with the earlier phases, because you were having daily movements and large amounts moving across, you more often than not saw tri-party services. But actually, as we work through the phases, we are seeing more third-party offerings come in.
Okay. And then just in terms of documents, so do you want to talk a little bit maybe about the CSDs and on what documents they?
Yeah, so again, if you look at Euroclear and Clearstream, the way that they operate is that you need to kind of join their platforms. And so what that means is that you need to sign up to their membership documents, which are standardized documents, but they require you to satisfy certain criteria. And so again, one of the things that we have seen as we work through the phases is that it just becomes harder for the firms coming into the later phases to actually either satisfy the criteria or want to satisfy the criteria, because it does require a bit of effort. So that's one of the things that we're seeing. And you have a slightly different approach with the bank custodians, which maybe Will and Doug can talk to.
I was just going to say, sorry, can I just a couple of points, and particularly on the Euroclear, because it is kind of recognised that certain sort of counterparties coming into scope don't satisfy the kind of direct membership criteria, and actually to deal with that, Euroclear has come up with a specific model, the Pledgey Rep model. I think actually ISTA has quite helpfully recently put out a video, which again, maybe we can circulate on their behalf, but there's a number of different custodians actually talking about how people can onboard. And so it's not just the case, particularly for Euroclear, if you can't directly, there is an option, but obviously there's these steps to go through. They're very time consuming and people should do them now. The only other point I just wanted to make, to be clear about to people, is you don't have to have the same custodian. So when obviously, this is a gross exchange, both parties are posting IM, but they don't need to both post to the same custodian, and they don't both need it to be tri-party or third party. So people are sort of clear of that. And actually historically, people have always seemed to kind of say, well, we respect your choice of custodian. We respect that it's better for you to post there. All of the custodians put out segregation opinions. Yeah. You should get them directly from the custodians actually, or ask, your counterparty who's using that custodian to provide it for you. So it's completely margin rule compliant, but often it's the preference, and there are reasons why. I don't know if you just wanted to add anything about that, because we see that a little bit with Euroclear sometimes, that people think because they're using another custodian.
Yeah, very, very much so. And what we have seen is counterparties limiting their choice or expanding their choice depending on how they want to trade and trade in the future. So when I'm speaking to counterparties and we're looking at specifically their treasury or their operations departments, they're looking at, from a future state perspective, am I going to make choices now that will limit my options of trading with certain dealers in 2 years' time, 4 years' time, 5 years' time? There's very few opportunities like these regulations which come along, which actually drive that type of infrastructure type change towards a future state. So where we see counterparties like Euroclear or using Euroclear or Clearstream, we know the majority of the large dealers use these ICSDs, but also have capability for bank custodians. There's obviously positives and negatives between them, but if you limit yourself to only onboarding to a single custodian and expecting dealers or your counterparts to use those same custodians, you're going to fall into a fairly narrow set of counterparties you can actually trade with. And going back to the threshold monitoring point, and if you ever thought that, all right, I only deal with 5 counterparties, well, that's 5 times 50 million's worth of threshold. I'm going to have to try to document and prepare myself for somebody. And what I would say, and I would always suggest, is try to build the broadest future state you can. Look at custodians or custodian capabilities between third party or tri-party that also potentially offer that representative model. So even if you don't necessarily want to trade with a counterparty that's using a Euroclear or a Clearstream, you have that optionality in the future.
Yeah.
And I was just going to say, it's probably a shameless plug, but actually HSBC is going to be a phase 6 custodian. And but just to say as well, actually ISDA has got very good infrastructure in place to make sure that new incoming custodians are having their documentation reviewed. And I think, the point we haven't made particularly drawn out so much is that I think there will also be a wider range of custodians. I've seen the sort of list that are coming out. Yeah,
there's about 13 custodians.
New ones.
Yeah, and overall in that working group. And it's an important point that you also need to think about the current custodians that you're using today. They might not be UMR compliant. To onboard with a UMR compliant custodian from start could take a couple of months. So you want to start that process very early, so you understand what custodian you're going to use. But also, for me, I see the custodian as king of UMR. And the reason I say that they're the king of UMR is that their deadlines are so important, because if you're not set up with them, you can't exchange collateral, and that's a regulatory breach. And when we look at phase 5, there are lots of last minute applications with these custodians. And so a lot of those relationships had to go on threshold monitoring because the accounts weren't set up in time. So, and we know that last week, Boney issued their deadlines. We've got Euroclear at the end of this month issuing theirs, and then Clearstream. So more and more custodians will be publishing their deadlines. So it's really important to understand what custodian you're going to go with, what's their deadline for third party or tri-party, or how does KYC, AML work. But also, if you're not on that custodian, you still also need to do some light onboarding as well. And by having the same custodian, you just reduce the onboarding task, and you reduce the documents. That's the benefit of having the same custodian. But to Emma's point, you can have mixture.
And I think, and I know you'll probably want to go to the US in a minute, but the other thing, I was talking about sort of volumes and bottlenecks, and I'm going to keep on the same theme. But, even though all these new custodians are coming in, which is great, there are probably still, in terms of bank custodians, a particular sort of provider who is going to be processing an awful lot of ACCAs. So I know, they're putting deadlines out. And actually, one thing I will say that I think it's really great, Boney has sort of recognised the volume, actually, that they dealt with in phase 5 and how they're addressing it for phase 6, and actually the fact that the documents now have been digitized and have become, what's the word, they're sort of not negotiable but electable. But actually that really helps when you've got a huge volume of documents. That's kind of what you just need to kind of get it done. And the fact that it's going to be run over, I think, the Create IQ platform, and people will be setting up their ACCAs on that's going to really help to manage when you've got a custodian that is going to be dealing with a huge volume. So it's actually pretty good that's happened. And we've actually kind of been doing sort of trials to see how the Create IQ works, setting up the ACCA, and it's been really good. So I don't know if the US
you will actually
wanted to
maybe
chip in on custody.
Will and Doug can just mention, so because Deepak talked a little bit about the documents that PSDs sign up, but there's these ACCAs that the bank custodians use. So I don't know whether Will and Doug, do you want to talk a little bit about the documents that the bank custodians use?
Yeah, so before that, just want to add, you also have an interesting point, right? Because under the US rules, your custodian cannot be an affiliate of you or your counterparty. So to the extent that you're trading with your dealer actually is also your custodian. So for that one particular relationship, you're going to find another custodian for you to post your Reg IM to. So that's something to keep in mind. We definitely have seen situation where sort of someone's sort of biggest trading relationship is actually with their dealer, who's also their bank custodian. That could be something that you kind of want to plan for. And then the other point to add is, so in the previous phases, you actually get to a point where basically all the negotiation on the account controlment agreement is done. But you're actually waiting for the custodian to turn to your spot in the queue to sign the actual document. So definitely you want to get the process started as early as possible. And in terms of documentation, when we refer to your IAM document, like it's really largely driven by the type of custodian you have. So depending on who your counterparty's custodian is and who your custodian is, you might end up with more than one IAM document. So for example, if your counterparty is using Euroclear and Clearstream, you're going to have to use the Euroclear Clearstream version of the IAM documents. And then for the bank custodian, you also have the bank custodian types of the IAM documents. So for example, you're posting to a custodian in New York, you'll be using the 2018 IAM CSA. So the number of your IAM documents might multiply depending on who you and your counterparty's custodians are.
Yeah.
I was just going to say, just to make a couple of points on that, actually. So, when we start negotiations, actually, it is very hard to start until those choices of custodians have been agreed. So that's kind of one thing. Again, I know everyone sort of says choose it early, but it does have a big impact on the negotiations because you don't know what documents you're negotiating until you have that information. And then the second point to make, I think, Chetan, you were kind of talking about the deadlines of the custodians. Because these ACCAs, when you're using the bank custodian, and you will need to put ACCAs in place, they have to be done by the particular deadline. The approach to the documentation historically, and it will continue for phase 6, is piecemeal, right? So you sign the ACCA first. Yeah, so when we're talking about managing volumes and stuff, I mean, we'll track it by the custodian deadlines. So you need, to have agreed it by a certain time, you need to have the ACCA signed, and then you will actually be signing your IM documents much, much closer to the 1st of September.
Maybe just to make it abundantly clear, just because I'm aware that some people perhaps won't be as familiar. So the ACCA is signed by both counterparties and the custodian, and it is what creates a tri-party relationship. It needs to be signed for each relationship, whereas for the CSDs, each entity needs to just sign the membership documents once. So you don't have to sign something with the custodian each time, although collateral schedules are one that you need to sign each time. But the account control agreement is on each relationship.
I guess just only because I was used to think about this. When we say tri-party agreement and ACCA, we don't mean the tri-party collateral management sort of angle. I know so
the account control agreement you'll sign whether it's a tri-party custodian or a third party, but it's only relevant in the bank custodian context. Yeah, good point.
Yeah. I always think if you sort of say it's a three-way document, because lots of rather than because people sometimes think, oh, does that mean I'm doing tri-party? But yeah, it's.
And I guess are there particular points that you've seen negotiated quite a lot in the in the bilateral documents? I guess so the ones between the two counterparties.
So it's interesting. On the ACCA documentation, what we were sort of saying before, I think actually a lot of them have become quite standardised now. So it's very, very limited in terms of what you can negotiate. As I said, you're more electing rather than negotiating. But on the initial margin documents, I think, and Jakir chip in as well, but on phase 5, we did see documents, I think, much more heavily negotiated than we had in the earlier phases. And again, to the point we're making, it's a different pool of people who are coming in. And I think one of the things, we had a lot of discussions about was around access timing, actually. And I wonder if some of that has stemmed a little bit from, people who've historically had SEG-IA arrangements, and those SEG-IA arrangements, it was very much driven, sort of as soon as my dealer defaults, I need to kind of yank back the IA that I've posted. Whereas for regulatory margin, first of all, it's two-way. So the terms very much are often kind of symmetrical. And secondly, the way I look at it is that this is the whole point, it's segregated, and that we have these segregation opinions, that it's protected there, right? So the idea that people really are trying to push the boundaries, kind of saying, as soon as I send in a notice, the collateral is released back. And I don't know, if you want to talk about control and
creates all sorts of fun legal issues around if you give either party the ability to access the IM before you even know whether it needs to be used for the purpose that we've actually stuck it in the account for, then it kind of raises issues around, is it fulfilling the regulatory obligation? Actually, if the trigger for returning of the collateral, is that compatible with insolvency rules? In the EU and the UK, we talk about the financial collateral regulations that actually mean that you have much more ready access to the collateral, but you need to have possession or control. If the collateral giver can just whip the assets away, actually, does the collateral taker have the requisite degree of control? So it's the kind of thing that lawyers get a bit excited about, as you can tell. But yeah, it is important, because it's not only a point that people view as a commercially important point. There are some legal ramifications that sit behind.
And also, I think, from a negotiation point of view, the minimum transfer amount, it sounds very basic, but you've got 500,000 as a maximum limit. So you've got to balance it between your VM MTA and your IM MTA. Yeah. So we do see people changing that quite a lot and negotiating that, because VM is obviously, there's no threshold, there's daily margin calls, whereas in IM you've got the tri-party agent, or you've got the calculation in place. It's also around what happens in the default, like you were saying, with the assets. So the different options as well. So that's what we see heavily negotiated on the buy side. And lastly, it's the independent amounts. What do you do around what we call kind of independent amounts? Do you go with the greater of, allocated, distinct approach? The three different approaches, what you do. So again, there's a lot of education about those three approaches, and there are pros and cons.
One point I just wanted to pick on with Dee actually talking about sort of, have we got the requisite amount of control? Is this structured as financial collateral arrangements where relevant? Is the consequences if it's not? And I'm sure the US will be happy to talk about their practice of sort of disapplying notice to contest and things, which I think is very prevalent in the US market, and that's sort of what has happened. But some of the consequences are that you may need to think about security interest registration, right? And actually some jurisdictions, you do need to think about security interest registration. I mean, we've just done a whole load for Israel, actually. And there's, certain places where, you absolutely need to make sure that the security interest you've just entered into actually works, and there might need to be sort of steps taken. Yeah. So that's why that aspect, I know you say lawyers get excited about it, but it might mean you have a whole load of other things you really need to do.
Yeah, it's absolutely right. So the benefits of having a security financial collateral arrangement are things like you don't have to register. Super important, because then otherwise you've got a security interest that's void against third-party creditors. Another one is lack of moratorium, right? Because one of the requirements under the margin rules is that you can access the IM in a timely manner. And if there is something under an insolvency law that's applicable to your counterparty that, for example, says no, upon an insolvency, a moratorium would be applicable, then actually, again, there's some complex conflicts of laws questions, but from an English law perspective, you do away with that moratorium risk if you know that you've got a security financial collateral arrangement.
Sorry, I was going to just move this on a little bit, and I know that Chetan, you wanted to mention something about legal opinions. Maybe now's a good time.
Yeah, sure. So under the EU regulations, there's an annual requirement to review your legal opinions with your custodian. So it's really important to have that process reviewed on an annual basis, and that all forms part of the risk management procedures. So when you go live with UMR, you need to have risk management procedures enhanced. So the regulator is really keen to see what your policies are, your procedures, your agreements, and that's that kind of annual process of legal opinions and an audit as well.
Yes, I think the point is that not only do you need to put in place these documents, I mean, obviously operational infrastructure, but then also some of the legal infrastructure behind that, the legal opinions.
Just kind of related to that, actually, because I think it's also very relevant for people to think about. So obviously with your legal opinions, you've got your segregation opinion, but you also need your collateral and netting opinions to actually make sure the whole thing works. And in fact, if there are particular issues with the counterparty's jurisdiction, or the jurisdiction where the collateral itself is being kind of segregated, in the EU and UK, there is actually a non-netting exemption where you do not have to exchange IM at all if that jurisdiction is not clean for netting, or indeed if the collateral arrangement wouldn't be enforceable. And there are some jurisdictions where actually, if we're talking about not being in scope at all, you don't have to do it because, and there are a couple of other exemptions in the rules that obviously people should make sure that, if they could fit into any exemption in the first place, that's an even better place to be.
Yeah, I'm sorry, because you mentioned exemption, for each regulation and each jurisdiction as they're written, the definitions of the exemptions differ from as you walk around the globe. So if you are trying to leverage an exemption, you need to have a discussion with your counterparty of what jurisdictions would apply to that regime, and then take a view on whether or not that exemption would apply. Now, we've seen lots of underlying beneficial owners like sovereign wealth funds or quasi-governmental entities who would like to take an exemption or leverage an exemption. But depending on how the regulations are written, whether it's under EMIR or whether it's under the HKMA regulations, the definition of sovereign or the definition of a governmental or a supranational entity, there's slight variations between them. So counterparties, we know we have asked counterparties to requested legal opinions to support their own definition of how they would classify themselves under a certain jurisdiction. And those are very much reliable to apply for an exemption. What we would and what we have seen is counterparties say, well, I believe I'm this, but you need your own counterparties to come along on that journey with you, especially if we've seen similar counterparties not leverage that exemption at all.
And you talk about exemptions because Emma talked about exemptions. But actually, there's a whole kind of day one classification piece around, are you a financial counterparty or an NFC plus, right? So a lot of people are kind of re-asking themselves that question because perhaps in the first instance, they didn't give it much thought. And so even there, particularly if you've got a third country entity, they have to ask themselves, what would they be? Were they an EU or a UK entity, which is actually sometimes not a straightforward question to answer.
So then I think moving on to, I guess, that final point around, I guess, how do you actually calculate margin, right? So it's very different to variation margin. There's, I think, two options. I think there's a real and do you want to talk a little bit about the choice around calculation and how you calculate financial margin?
Yeah, Hannah. So your choice basically either using the SIM model or end up using the regulatory grid that's specified in the relevant jurisdictions. And your agreement with your counterparty is going to be evidenced in your IM document in the regime table. So there you can elect whether you want SIM to apply to all your transaction or some of your transactions, and then use the grid for others. So I kind of stopped there, right? So in the US side, I think the regulatory obligations on the dealer side. So I think the buy side entities wouldn't really spend the time to kind of have their come up with their own model. But the question is whether you want to engage a third-party vendor in order to sort of have them help you calculate the SIM number, in order to sort of make sure your dealer is making the right call.
Yeah, and I don't know whether you see much around delegation.
Yeah, so like when we started this journey, back in 2016, we had to build the model ourselves. So I was representing Standard Chartered Bank, HSBC, but now when we fast forward to this year, there are so many technology vendors out there that you can buy the technology and the license. So there's about 19 ISDA-SIM license providers out there. So the challenge now is finding which is the right one for you, looking at your existing technology. And the calculations are now very robust, and the dealers do provide calculations, and you can rely on them based on the US rules. But in Europe, you need to have an independent validation on that to make sure that you are independently checking that number from the dealer's point of view. So again, the dealers provide these calculations on a daily basis, and it's a great way to consume that to allow you to prioritize and also realize how quickly you're going to burn that 50 million threshold. And you can have a mixture of models as well. So we see that as well. So some clients want to have, say, rates on the SIM model and then everything else on the grid. So it's not one model for everything.
If I were to be very general about which model we'd take, if you've got a multi-currency, well-balanced portfolio, well-hedged, the SIM model is vastly preferable to the regulatory grid. Regulatory grid is pretty much notional based. But if you have a directional portfolio, I do one single type of trade and I do that all day, every day, and the majority of it is just covering risk, then I would steer away from the SIM model. It's overly complicated and doesn't give me that much benefit over that regulatory grid. So your counterparty should be able to tell you which one's more appropriate for the type of trading you do. And that should help inform whether or not you should be outreaching to a vendor or for that SIM service, whether or not your counterparty can do that for you.
Yeah.
One thing I would just pick up, because we didn't really cover it in the negotiations piece, but between the model itself, what you're calculating on the grid and what you're delivering out the door, there's one obscure election within the initial margin document, which is the termination currency, which everybody has in their ISDAs with their counterparties at the moment, which has no bearing on day-to-day function. It's something you agreed in 1992, if we're going back that far. It's probably dollars, it's probably sterling or euros. It only matters on default. Each of the regulations has stipulated that that termination currency is now essentially your settlement currency for your collateral. So if your termination currency in your ISDA is dollars, then the haircuts applied in your collateral schedule under the regulations can be set at the base minimum. If you're posting something other than that base currency, you have to add an additional 8% haircut. Now, the majority of counterparties we've seen in the previous phases have no idea what their base currency is today and whether or not they would like to change it. Between at least HSBC, we are a global bank, we've got 4 different base currencies, depending on where the ISDA was signed. And what we would do is suggest that we would elect a different termination currency between both counterparties. So counterparty A can elect a counterpart termination currency which they would prefer to post in. So let's say I only post in US Treasuries, I'm going to want a US dollar termination currency. But if it's HSBC, maybe it's sterling, maybe it's Japanese JGBs out the door every day. Maybe we would prefer to elect a Japanese termination currency. Now, that obviously still doesn't have an impact on our day-to-day workings, on how the ISDA functions. But what it does do is it gives us relief on the collateral that's being posted out the door, that we're not being charged an additional 8% haircut on that collateral amount.
I was just going to make two really quick points on that, actually, is that it is the case that historically in a lot of ISDA master agreements, when people kind of were writing in what the termination currency was, they would stipulate a currency, but then they would also put in this line saying, or such other currency as the non-defaulting currency you may select, etc. So now the margin rules themselves, I think this is true for the US and EU, UK, right? Says it has to be a single termination currency. So this kind of line where it's dollars, or if I fancy something else, I can let you know that's actually not margin rule compliant. So if you have got that old line in your ISDA, it needs to be amended anyway to be margin rule compliant. The second point as well, and I think we see a lot of confusion, is actually this termination currency for the purposes of where do I apply this 8% haircut on the IM, it's actually the other party's termination currency. So say, for example, if I'm facing Jakir and Jakir wants to post JGBs, Jakir is going to ask me to have as my termination currency the Japanese yen. And we've actually, in the 4i checks that we've done on agreements, we've picked up so many that people have kind of got it the wrong way round. But actually, it could have a really big impact. I think as well, though, when you set up, certainly when you're using tri-party, you set up the eligible collateral schedules, you do put the relevant termination currency there. So you need to make sure that matches. Sorry, Hannah's looking at me because...
I was going to say, unfortunately, as you can see, we're all very enthusiastic about the subject and we could talk about it for a lot longer, but unfortunately, I think we're at time. So I guess our key takeaway really is around there's a lot to think about, and you can't start early enough. So if you have any questions and want to reach out, I think all of us would be very open to having a conversation and answering any questions you have. Our contact details will come out in the follow-up comms. But thank you very much for joining us, and we look forward to seeing you all in person hopefully soon.
Thank you.
Thank you.
Thank you.